going DeFi, greatest in the world, and they finally about to see why. What you know about XRD? I'm smart money, I ain't never on a decline. What you know about NFTs? It's not just Ace, when you finally gonna realize you need scalability, need more utility, then you better call on these guys. I'm going radical, I'm going Radix, I'm going radical, I'm going Radix. Hyperspeed DeFi, never on a decline, building the future, I feel like a savage.
Hello and welcome. I am Piers and Tommy, CEO of RDX Works, a core developer of the decentralized finance protocol Radix, a public ledger entirely focused on bringing DeFi into the mainstream. This is our podcast, The DeFi Download, a show about decentralized finance and all things crypto, where we dive into the details of the products, assets, and services that are powering the DeFi revolution. Today, I'm joined by Tommy Johnson, co-founder of PsyFi. PsyFi is a two-sided DeFi marketplace for structured products, which lets people earn yield on their assets they already own and traders to either hedge or leverage their portfolio. Tommy, thank you so much for coming on the show.
Thank you for having me.
All right, so let's start off with, what is a structured product?
That's a complicated question. A structured product is a group of different assets or products that make up a single new product. So I'll give you some examples to break it down.
It's like a meta product. It's the meta product of the finance space.
Exactly. That's the best way to describe it. So there are spread structured products, covered calls, secured puts. I mean, these are kind of products that PsyFi actually wraps up and tokenizes. And so you could a covered call selling strategy just sells calls week to week. A call is where you specify a strike price, and if you're selling the call, you're taking the position that the price of the underlying asset, let's say Solana, for example, would not cross that strike price or go above it. Let's say it's $25 given today's price by the expiration date of the call.
So let's give us like an actual example. I own some Solana, and I'm holding on to this Solana. I'm long Solana. Solana's good for me. I'm happy with it. So I don't think I'm going to sell it for the next year. So what I want to do is I want to earn some extra yield on it. Now, a covered call, you have to own the underlying to be able to sell the call, right?
Correct.
So I own Solana. I've got 100 Solana, right? And I go onto your platform and I go, right, in the next 30 days, it seems like everyone on crypto Twitter thinks that Solana is going to moon. I don't actually think it's going to moon. I think it's going to take another couple of months. So to arbitrage that, to make some profit, what I'll do is I will sell the upside on my asset. I think it's only ever good. I think it's whatever it's trading at today. I only think it's going to go 20% above this in the next 2 weeks. So I'm willing to sell the upside to a trader who will buy from me the asset increase over 20% of current strike price. So let's say current traded price is $25. Let's say it's $25. So I will sell someone a $30 option, a $30 strike price option on my Solana, and your protocol will let me do that because I own the Solana. So I lock up the Solana. And then in 2 weeks' time, and I'm assuming these are European options, or are they European options?
European.
Right. So European option means that it can only be called at the date. You can't call it before. American options, you can call it anytime up to the date. European options, that date is the date, right? So 2 weeks' time, if it's at $30 or above, I pay whatever, the trader makes whatever above that the price is. So it's at $40, then the trader's basically making $10 per option they bought, because I sold it at 30, the price is at 40, $10 per option. If it's below that and it only gets to, $29, then I make all of the money. The trader had to pay me for the right to have that. I made all of the money. And that's essentially what a structured structure, what a covered call is, right?
Correct. That's exactly right.
Okay. And when that happens, is the amount of money that the trader makes, is that coming out of my Solana?
Correct. Everything is denoted in the underlying, just so that way it makes it simple. You don't have to deposit Solana or USDC into these kinds of products. So you actually just lose a percentage of your Solana based on how much percent out of the money. So in your use case where it's $40 and the strike price was $30, you'd lose about 25% of your underlying Solana that you had deposited.
Right. So
they're paying in Solana too. So you're compounding your Solana when the options do not get assigned.
Right. So I haven't lost value per se. The value of Solana has gone up, but I've lost the number of Solana I own because the value went up more than where I thought it was. So a lot of the time people talk about this as selling volatility, and that's essentially what I'm doing. I'm selling the volatility of the asset. So I'm selling the potential upside of an asset over a certain price for the view that I'll be able to make carry. I'll be able to make money from people paying me for that right more than I will from the losses of the asset actually mooning, and most of my portfolio amount disappears, and I sold the right to have the ability to have all of the upside in my portfolio for a smaller amount of money. And just so that people understand, for a 2-week covered call on Solana, how much would I be expecting to make on that?
Right now we do weekly options. That's generally like what most interest is in the market.
Okay.
And just looking at the historical performance, last week it made 0.35% just on that week alone.
Right.
Overall, the aggregate is looking like 12% APY for Solana covered calls. And again, this is all, the APY depends.
0.13% in a given week period.
It was 0.35% last week.
Beg your pardon. 0.35%. Okay.
Right.
So the payoff is asymmetric. It's not it doesn't look like a neat curve. It's not something that people would just look at this and go, oh, I put, like I would in Aave, right? I put my money in Aave. I put my Solana, wrap Solana in this case, in Aave, or my ETH in Aave, or my USDC in Aave, and I'll either make more yield or less yield, but I won't lose any of my principal. In this case, I can kind of end up making, I can end up in these weird payoff scenarios where I can end up making lots and lots of money, and then suddenly I make no money, and then I'm in loss. And that can actually happen quite quickly, depending on how volatile the asset is.
Yep, that's exactly correct. So we'd categorize this as a more risky product than an over-collateralized borrow lending product like Aave.
Right. So why does the market need this? Why is this useful?
When yields were really low across a lower interest rate environment, and so what I mean by that is we've seen the Fed hike interest rates to levels they haven't seen in many years. Sure. There was still a lot of volatility in the crypto space, and that volatility led to high yields on these kinds of strategies and these structured products. In an environment like today, we can recognize that there are other places that you can park your assets and money depending on what you're holding. Obviously, you can't put Solana into treasuries, but if you're putting USDC into a structured product like a secured put that collateralizes in USDC, it might not be, the risk reward might not be worth it, because these products, you are taking some directional risk. Right. So I think a lot of these products, whether it's the covered calls, secured puts, or a structured product that uses a combination of multiple options, it really just depends on the directional view you're taking, because there is some directional view of these products, unlike Aave.
Right. So this is not a sort of like leave it and see what happens in a year's time kind of product, but it does give the opportunity for people to make actually quite impressive yields on the assets that they hold. And on the other side, like the people who are buying these products, who are buying sort of a covered call or a secured put, like what functionality does that, what useful functionality does that provide to market actors? Why does that need to exist?
So there's speculators, people who believe that volatility is going to increase or the price is going to moon. Like let's say Solana, that example, you may think it's going to stay under 30. They might think it's going to break out past 30. And they want to buy those options or at least bid on them to try and win. So they can take that directional view. And that I would classify as people who are speculating. They have some sort of market opinion or market view. And then there's other more institutional market makers that have positions in a bunch of other products, whether it's perpetual futures, dated futures, and just holding tokens. They may be hedging across their book. So they may be buying that volatility to not take a direction, but to even out some direction that their book has put them in.
Right. So this is there's like the ability for people to, and just to sort of like explain that a bit more, I could buy Solana at $25, or I could spend $25 in covered call options that are priced out of the money. So, its current price is $25. I buy options at $30 to buy at $30, so 20% market movement. But I can buy, each one of those options maybe costs me a couple of dollars. And so I can buy many, many more times, in this case, more than 10 times more exposure to that asset in the covered calls than I can in owning the underlying. But I'm taking a very narrow time horizon on this. I'm basically betting on the underlying volatility of the asset over that time horizon, the 1 week period. So I can really leverage up. I could take the other position though, and I think honestly, this is where I think the utility is much more in these products from a why is this necessary in the market point of view rather than just a gambling point of view. If I own a big portfolio of assets, but I think that there's going to be a big negative movement, and at the same time, let's say I'm lending out some of those assets and I don't want to get margin called on my assets, I could take a put on the asset that I'm lending out. So let's say that I've got ETH and I'm in my MakerDAO vault, and I've taken out some DAI, made some DAI stable coin from my ETH, and now I'm doing something and I've locked it up, and I'm like, I don't want to no longer be long ETH. I don't want to get zeroed out of my MakerDAO vault, out of my CDP. I don't want to remove my DAI because I'm providing liquidity to something that actually matters. But now I need to make sure that if the Ethereum price drops, I don't end up in a situation where I can't cover the payback that I need to do in my MakerDAO vault. So what I'll do is I'll go short Ethereum. I'll buy a secured put from PsyFi, and then I can cover that position on the potential that the market moves against me, but now I'm able to hedge my risk. And I think this is a really important new thing that's going to come into the market more and more, which is this ability to hedge your risk of your exposure, especially as leverage and more sort of composability of these financial primitives, the way in which people are sort of like taking one financial primitive, putting it into another, then taking that, putting it into another, and then taking that, putting it into another, like you're seeing in Curve, like you're seeing in, like we saw in Popsicle Finance, like we saw in Magic Internet Money, and like we're sort of seeing, I think this next wave of DeFi is becoming even more sophisticated. So that's where I see sort of the real value coming from. Are you seeing a lot of people using your protocol for hedging, or is it mostly for speculation at the moment?
I think a lot of it is speculation right now. TVL has significantly gone out with the broader market over the last 9 to 12 months. So there's less institutional demand on either side, but we have more savvy, smaller players that are definitely hedging some positions. But I'm going to guess, and I don't have data to back this up, that a lot of it is still speculation with directional views. But going back to like what your point about all these plug and play pieces and the incredible breakdown of how you might want to hedge your risk when you're borrowing DAI against your ETH, that kind of led us to building a borrow lending protocol that takes these structured product tokens as collateral. Not only does that give more capital efficiency for the people who want to purchase these options, where they could deposit assets and borrow against those, earn yield, and make purchases. But those who are holding these vault tokens, if you're holding secured puts or holding short secured puts, then those can be priced and you can actually just borrow straight against those. And we'd love to see other borrow lending protocols actually integrate that, because it is such a useful case to hedge positions when you're borrowing a stable asset against collateral that's unstable.
So an example of this would be I take my Ethereum, I take my Solana, I sell my my covered call, but my Solana value has got a market value right now that I could reasonably borrow against still. So I can take my covered call position, but I can still borrow stablecoin against that, because
correct,
there's still all of the value that I've actually put in that vault. And if the price goes up, it doesn't matter, because the price has gone up and you're only going to be losing a proportion of those assets in line with whatever you've sold as your covered call. But that doesn't matter from the point of view of borrowing, because your collateralization ratio is only going to get better in a covered call scenario, right?
Right. Yeah. And so like the borrow lending protocol normalizes everything to USD. And just
Right.
as we broke down what we call a payoff chart for the covered call, if the asset, if Solana goes above $30 and the strike price is $30, well, the value of each covered call or short covered call token, right, is capped at $30. So just like you have that cap in your upside, the price of that, what you can borrow against, is capped. But if you deposited when it was an out of the money call and you haven't, continued to lever up your position or borrow against it, well, ideally you are still within your borrow limits.
Got it. Okay. So that's really interesting. And are you seeing much take up in the borrow lend protocol? Because I understand it's one of the things that people often talk about when they talk about options markets, is how capital efficient an options market is, especially when you're doing it as a smart contract, where many options markets can do things like capital calls on institutions that have a line of credit with them. But in this case, you can't do that. There isn't such thing as a line of credit. So you have to find other ways of making it more capital efficient. And obviously, for me to buy, if I wanted to sell a covered call in Solana, but I didn't own any Solana, I'm just looking at it and going, looks like there's a large demand for buying Solana covered calls here. But to earn that 0.35% on a week, I'd have to go out and buy Solana to be able to sell it, because it has to be a covered call, because otherwise you have no way of assuring the other side of the market is going to pay out. So you had to solve that problem. But now you've got the problem that the selling of the covered call is now very capital inefficient, because I have to own the underlying in order to sell it in the first place. And so I'm assuming this is why the borrow lend protocol sort of came into being in the first place.
Yes, exactly. And then not just the use case of if you don't own the underlying asset that is collateralizing the structured product, but also if you are you could leverage up your structured product, right? If you are depositing SOL into a SOL covered call, you could then deposit that short covered call structured product token into the borrow lending protocol and borrow more SOL against it,
right,
to deposit more and create that kind of cyclic until you're at your max leverage or your max borrowing limits. Right. The other thing is you could deposit, if you wanted to hedge your position, you could deposit, if you think the volatility is going to spike one week, or in the same vein that Solana is going to exceed the next week's strike price, you could take your covered call position, borrow some USDC, and purchase some of the covered calls to hedge your position and hedge your exposure. And so that way you kind of you reduce your risk without having to manage the position as much by just withdrawing. Or you could take a direction on another call and get some sort of hedging that's not direct one-to-one hedging.
Right. Okay. So this all works very well. Sort of when interest rates were not high, obviously the Fed is now competing with everyone else for capital and is winning, because at the moment the market seems to think that the risk reward ratio of depositing money with the Fed is better than what can be got elsewhere, because America's still AAA rated. I don't know how long that's going to last, but while it does still last, you obviously have this what often people talk about is your hurdle rate, right? And so up until the rate hikes, the hurdle rate for investment was very low, because you just had to beat the Fed rate, and because interest rate had been so low for so long, all corporate bond rates were also like very low, and so your ability to get return on capital was pretty low, and so people were looking to more exotic products. Now we're in a situation where return on capital just by depositing with treasuries with the Fed is actually pretty high from a risk reward point of view. And so there's been like a flight out of riskier bets in the market. So what have you got? How have you guys responded? What have you guys done to sort of think about what your next products are going to be and how to operate in this higher yield environment that the Fed has created for us?
Yeah, that's a great question and backdrop. I mean, these products are very market specific, and to be have a holistic financial products, suite of products in a platform, you need to cater to all these market conditions. And some of these extreme directional views don't pay enough given the volatility and smart contract risk and other risks that are baked into it to compete with the Fed's, more or less risk-free rate. So we started working on, over the last quarter or two, a market-making vault product where users can deposit two-sided liquidity, so Solana and USDC, and that vault will provide liquidity and market make on a concentrated liquidity protocol, similar to Uniswap's V3, Orca's Whirlpools if you're Solana native, where it's more efficient than an AMM, but it requires more management of those positions. And so the reason this product is so powerful and compelling is there's less risk, because you're not making extreme directional views on short time horizons. And when there's still a lot of volatility and volume, which volatility can create volume on underlying tokens in spot markets. So Solana and USDC is trading hands very quickly. If you're providing liquidity to these protocols, you can generate fees based on participating and providing liquidity for those trades.
Right. And
so if you can have it professionally managed, and you can concentrate liquidity more efficiently. I'm not going to go into the technical details. We're waiting to release those in a few weeks. But when you can concentrate liquidity and much more efficiently, you can capture significant shares of the volumes and generate significant fees for the people who are those liquidity providers. And so that's really what we've been focusing on. And along the same lines is Solana's ecosystem is plagued by poor liquidity, but also poor blue chip tokens and things of that nature. So along that same platform, we're building a liquidity bootstrap curve to help people launch tokens. But our core focus is really that market making vault product.
That's really interesting. And I think that, I have a saying, which is there's two company types in crypto that to date seem to have been the most profitable company types to have created. The first is centralized exchanges, and the second is market makers. And I think essentially giving a way of democratizing the ability to earn market maker returns, and also there's often a scale. Market making is often a game of economies of scale as well. And some of the best strategies don't always win, because if you have the best strategies but you don't necessarily have enough capital to deploy those strategies, you can still end up making much less returns than the larger market makers can. What you're doing here is you're saying, hey, what if we created a vault that allowed people to provide capital to professional market makers within DeFi, and then make a return from the capital that those from the algorithms that those market makers are allocating to the market. And a good market maker should be delta neutral. They shouldn't be taking directional views over time on positions. So you should be getting just risk-adjusted returns on your assets for doing that. Obviously, this is slightly out of the realm of just standard algorithms. This is in the realm of whitelisting market makers to be able to access this capital, to be able to deploy it on specific markets. So how are you guys selecting your market makers, and how are you making sure that those market makers are good before they get access to that capital?
So we're starting with one. Anyone could spin up, the protocol itself allows for multiple vaults with different market makers on the same trading pair. So we're starting with one to dog food this, and we'll start with a couple pairs with limited caps on the amount of assets that can be deposited. And then we'll track the history and perform. And this is a professional market maker. They come from the big traditional finance, high frequency trading shops, and understand how to trade and ingest data and make decisions based on all the data they have available off chain. But so I think over time, what we'll see is that there'll be a history of fees generated per TVL or per liquidity in a specific market maker's vault. And you can kind of see people gravitate towards the most successful market makers. They might have access to different proprietary data or other trading. Someone like a Jump has very different data than some retail market maker that's just providing small amounts of liquidity to DeFi. And they can make much more informed decisions based on the broader market. So I think that's what we'll see in the long term. But it's set up that multiple market makers could compete on various vaults, or trading pairs.
That's really cool. So when's that launch?
We're going to DevNet. We're on DevNet right now this week, next week, and we'll probably launch officially in 4 to 5 weeks.
4 to 5 weeks. So sometime in August.
Yeah.
Cool.
Yeah.
Awesome. Very cool. Well, Tommy, it's been such a pleasure talking with you. Thank you so much for coming on the show. Really interesting to sort of dive into the details of PsyFi. For those who are wondering, it's PsyFi, as in psychology, PsyFi. And I definitely recommend checking out their website, psyfi.io. I'm going to put that in the show notes. That's psyfi.io to learn more. And then, Tommy, is there anything that you would suggest people go into specifically? Is there anywhere that any articles or videos or anything that they should read to sort of get a better feel for what the product is before they get started?
I think read the documentation, docs.psyfi.io.
Yep.
I think there's going to be a lot more coming. As we mentioned on this podcast, you want to choose products based on market conditions and risk-adjusted returns. So I think this next product coming out, definitely pay attention to our Twitter. It's at PsyOptions. We were formerly PsyOptions, so PSYOPTIONS. And look for the new stuff coming out in the next few weeks.
Awesome. Thank you very much, Tommy.
Thank you so much, Piers.
Need more utility, then you better call on these guys. I'm going radical, I'm going Radix, I'm going radical, I'm going Radix. Hyperspeed DeFi, never on a decline. Building the future, I feel like a savage.